In today's article, I am going to kick off my new series on Forex strategy analysis. That's where I take trade ideas, concepts, or strategies out there in the Forex wild, do some data mining, show some cool graphs, hunt for correlations, and try spot any statistical hotspots we can exploit for dollar. Basically, does the strategy work or not? If so, where is it working, and where is it not? If the data demonstrates some statistical edges, we run the strategy through a trading robot backtest to simulate how they would perform. Note: free Forex robot included at the end, so you can run your tests. Since this is my first candlestick pattern strategy evaluation, I wanted to focus on something really simple: the candle body. Does the candle body thickness have predictive powers? Can it give us an edge? Let's dive in and do some deep, but fun analysis on the candle body's secrets. The candlestick body chart pattern strategy explained quite a few years ago. Browsing a Forex forum, I came across a group of price action traders who only used the candle body to make a trading decision. If a candle closed bullish, they were long. If a candle closed bearish, sells were open. This kind of strategy seems really stupid simple, and probably is one of the simplest candlestick strategy ideas out there. Trading the strategy with such simple rules would straight up not work at all. The success would be very hit and miss depending on market volatility. This concept is missing one thing: some quality control. The market is not going to just let you profit off the direction of the candle close in the long run. For example, imagine using these rules in heavy consolidation. You would be flipping trades every day with building frustration. But there may be some merit to the idea if we introduce some other metrics and rules. The theory goes like this: when you see a candle with a large, thick body, you generally do see good follow-through from price in the same direction. A picture says it all. Here is an overview of the success condition we are trying to measure. Basically, we want to know if a candle closes with a bullish body, what is the percentage chance we will see a higher close before a lower close? Our stop loss for the experiment will be placed at the opposite end of the candle. In other words, to be considered a bullish signal success, a candle must close past the signal candle high before a candle breaks the opposite side. Invert those rules for bearish conditions. If a candle closes bearish, what percentage chance are we likely to see the lower close first? Candles closing inside the signal candle's range are our null event. We wait for either that explicit higher close, or lower close, past the signal candle's range. Let's check out how that looks in theory on the charts. Above, in a bull run, this idea would thrive. A nice stack of bullish-bodied candles would create a burst of lucrative trading. The same goes for bearish runs. A nice bearish waterfall would bring the profits up quickly. But these are the textbook conditions for this strategy. How often can we expect these picture-perfect scenarios to pop up, and when are we going to know they will happen? We don't. We can't rely on being carried by a huge market rally every day. That's why it is important to start introducing some quality control metrics to be able to filter the good from the bad. The size of the candle body. Measuring candlestick size. One of the obvious, first measurements we can observe is how the candle body's size affects the success, failure of the signal. The body size should be a big deal. Imagine a small doji candle versus a big thick-bodied power candle. The difference between the two, I would imagine, would be quite dramatic, but you never know. But what are we going to compare it with? We can't measure body size against a hard set number, like body size compared to 300 pips. The average trading range between markets changes dramatically. Gold can move 2,000 points a session, making the static pip measurement a bogus reference. But the average trading range, ATR. We can measure the candle's body size against the current average trading range's value. That way we have a relative metric to measure the body size against, which adjusts to market conditions. If the market is pushing out some big candles, then the ATR will scale up and also scale down in slow conditions. I decided to measure the candle's body size versus the ATR as a percentage. Let's consider the ATR was 50 pips. If the candle body measured 50 pips, then the percentage would be 100%, because the candle body is 100% the size of the ATR. If the candle body measured 25 pips, that's 50% of the ATR. If the candle body measured 80 pips, that's 160% of the ATR, representing a candle body that is larger than the current volatility. Alright, so let's show some graphs. Below is the success, failed histogram, which illustrates the data with clarity. The x-axis shows how the body size versus ATR, 20 period, affects the signal performance. Here is an example. The bottom graph is my nicely color-coded probabilities histogram, showing us where the strong advantages are in the data, if they exist. Going by this graph, it seems there is a clear edge when the body size is above 85% of the ATR. However, if we look at the success, fail histogram above, we can see there are not many trades above 130%, so the opportunity seems to be between 85 to 120% of the ATR. But I've also added another observation on the chart, which is the profitability threshold. When the bars are above the threshold, the system has a chance to make money. The further above the line, the more likely it is to make money over the long term. It uses the average return on risk for each bin range on the x-axis to establish how each x-value range, the body size of the candle versus the ATR, affects profitability. This example chart doesn't look healthy, with most bars falling below the profit line. You can also think about this line as a break-even marker. Wait, don't throw down the hammer and make conclusions just yet. This is only the GBust. There are many other markets to run the data on. Not only that, this is the 6-hour time frame. What about the other time frames? I decided to include most of the swing trading time frames: 1 hour, 4 hour, 6 hour, 8 hour, 12-hour daily. I also threw in the 15 minutes chart to satisfy the high-frequency junkies, day traders, out there. I personally hate those lower time frames, but I will let the data do the talking. For markets to run this strategy on, I picked a handful of different markets to save time on the data mining process. I would be here forever processing every single market and time frame variant. Eurust GBust Audist Urgp GBP NZD Oddenst Gold Crude Oil S&P. Every Forex strategy will perform differently on individual markets. A strategy could be a big winner on Eurust, but wipe an account on GBP NZD. This spread of market will provide a nice variety, and a good idea on how the strategy performs across our test basket of markets. For a general performance metric, we can always test on more instruments if the results are promising. So let's look at some graphs. Raw candlestick body size versus ATR performance. To avoid bloating the article with hundreds of graphs, we can consolidate data groups together to see if any nice metrics pop out at us. If they do, we can get more granular. As I mentioned before, I included the 15 minutes time frame. So let's start from the bottom. Not expecting much magic from this low time frame data, to be brutally honest with you. Below is the consolidated 15 minutes data of all the test symbols to highlight the candlestick pattern strategy performance across the board. As expected, a poor result. None of the candle body sizes are able to make it over the profitability line. One correlation visible here is that the success chance increases as the body size of the candle gets higher. You might be thinking, wait, I see 60 to 70% win rates. That's true, the trades are hitting the success condition frequently, but the reward is poor versus the risk taken, meaning each failed trade becomes very punishing to the system. What about the 1 hour? Not really much going on for 1 hour either. The 1 hour chart is not easy to trade anyway. The candles still don't have much price action data within them. Stepping it up a notch to the 4 to 6 hour range. Only negligible improvements. The candle body really needs to be 135% of the ATR to be able to flirt with the break-even mark. Finally, my favorite swing trading time frames, the 8H to daily charts. Honestly, I thought we would see some improvement here. However, this data is really disappointing too. The best of the worst seems to be the 4-6 hour range, when the candle body is above 115% of the ATR. For fun, let's run through a few back test results. and observe how the equity curve looks like on that data range. Starting from the bottom, here at some 15 minutes time frame results, setting the minimum candle body size of 160%, as that was the only range that came close to the profitability line on the performance graphs. As you can see, the 15 minutes chart results would have brought tears to a grown man's face if you let this system run on your live account. Total trash results. The performance graphs shown earlier anticipated this. Moving along to some 6-hour time frame figures. I am not showing every single symbol, otherwise the article will be too bloated. The minutes ATR was set to 115% this time. As the performance evaluation charts showed, this is where the best performance started to kick in. Sideways results as expected. As the performance charts implied this would happen, none of the bars on the 6-hour data chart really cleared the profitability line, so break-even was the best case scenario here. Moving along to the daily, where I would usually expect cleaner results. The daily results were the most stable so far, but still nothing to get excited about. However, there was this one. The Eurust daily output was a pretty damn good equity curve. Just a candle body trader with a minutes input of 115% makes money! Buzzkill. 10% account gain over the 3-year trading period isn't impressive. Even though it turned a profit, it was a very slow snail system. So what can we take away here? Checkpoint. One clear correlation in the data is the larger the candle body size, the higher chance we get to a trade success condition, a higher or lower close. Although we have high win rates, the reward output is so bad for each trade, we can't get over that profitability threshold, causing stop-outs in the system to be so destructive and therefore consuming all rewards plus more. This system is not viable with these very simple rules. Even though the special case of Eurust made a profit, it was still a very slow crawl with a few 6-month periods of no profits.